Welcome to SF Live. My name is Stephen Case. I'm the CEO and president of Fox River Resources, and I'm here with Kai Hoffmann.
Fantastic. Steve, thanks so much for the introduction. Really appreciate it. Thanks for coming on the
you.
program. And I tweeted about Fox River Resources and your PA this morning, and it really interested me. And I reached out, I was like, guys, we got to talk. I know nothing about Fox River Resources. I know nothing about Phosphate. But I was quite intrigued because your guys are a 37 million market cap company. You put out a PEA with $2.5 billion in after-tax NPV. So there's obviously a bit of a disconnect. And my idea was, let's see if there's a trade to be had, right? So I appreciate to come on the show.
Thank you.
Let's start with a bit of a basics, I think. Like, before we dive into the whole matter of Fox River Resources, I want to learn a bit more of Phosphate. I think it's come. Let me just maybe why I'm interested, because it's been in everybody's mouth as of the Ukraine and Russia crisis. So maybe you can elaborate on that and why it's moved into the limelight.
Okay, so you, first of all, you have to back up to understand the fertilizer business in general. You have to understand the grain markets and the correlation between the movement of grain prices and the movement of fertilizer stocks has a basic R of 0.86, and with one obviously being absolute. So they correlate to each other almost on an absolute basis. And the reason that is that as a farmer sees higher grain prices, he chases higher yields in his crop production, and in order to do that, he has to use more fertilizer. So there, it's a symbiotic relationship. And what you need to understand is, obviously, we have a very strong grain market, and that is being driven by the fact that when food intersects with fuel, that's the kind of market that's not transitory. It's not a drought-induced cycle that is very transitory. It maybe last a year or a year and a half. But when food intersects, or when fuel intersects food, that's the kind of cycle that has long legs. And the last time that you witnessed that was back in the birth of the ethanol business. It took place in the 2006 to 2009, and arguably got interrupted by the financial crisis. But that's the kind of environment that you're in now. What you're talking about with regards to Russia, that is unforeseen circumstances, which has only added fuel to the fire. But the basis in which this cycle has been brewing for the last 14 months, or almost 18 months for those that were paying attention, is the fact that, like the ethanol business that went on to consume 40% of all the corn production in the U.S., and it was unfolded by mom and pops and co-ops at the birth of that business. You now have that taking place in what you call renewable diesel, and renewable diesel is 100% consumable. You don't change your engine. And it's being promoted by the governments around the world because it's got a lower carbon footprint, and it is being embraced by big oil. So it's not the mom and pops this time, and it will eventually, by 2025, consume 50% of all the soybeans this time that are grown in the U.S. And it's gone global because it's the green answer to a lot of things. It's got a much lower carbon footprint, and because of that, it's being driven by government. And you can't take essentially half of the soybean production out of the U.S. and not have that affect grain prices, just like corn did. I remember the first time in 2006 when I, wrote the first, I guess, piece on, buy the farmer, sell the ethanol player. I can tell you, I got kicked out of the first 6 hedge fund offices in New York saying, corn's been $2.50 for 30 years. Get out of my office. And by the way, I got $100 million in these new ethanol plants, and I'm going to make a lot of money. And what they didn't understand is that what was going to take place. And if you fast forward those 3 years from 06 to 09, corn went from $2.50 to $10. And the same thing's actually happening, but this time on the renewable diesel, and it's being embraced, as I said, by big oil. And half of the current capacity that's coming on by 2025 is under construction and due to come on by the end of 2022. Now, if you put the Russia circumstances on top of that, there are two things occurring here. And the fact that Ukraine is responsible for 10% of all the global corn export, and that's just been rearranged. And if you back up even further to that macro, you have the balkanization of the commodity complex, or the return of what I would call a dislocated supply chain, and that has all commodities being restructured, and you throw inflation on top of that, you're in the type of environment that has legs. And if you think that, even if Putin was to walk away today, they're going to keep those restrictions on him until he's replaced. And so that has a huge effect on grain prices, and thus it has a huge effect on fertilizer prices, because Russia itself is responsible for 10 million tons of phosphate production per annum. And you're talking about a market that's 85 million tons a year, and you just had arguably 12% of it disappear. And on top of that, you've had China restrict phosphates. So in essence, the whole fertilizer complex has been shaken on, and we're now going to have to actually worry more about can you get it at the end of the day.
Stephen, that's a very good point. Like, where does the U.S. and Canada get their phosphate from? Like,
well, right now, Canada imports 100% of its phosphate. That's the situation now. We get most of it from the States. In fact, almost all of it from the States. It's either down in Central Florida, Gulf area, or there's some out in Idaho, and those are the main three kind of production points. But we import 100% in Canada, and that market is the fastest growing market in North America. And when we speak of Canada, we're really speaking about Western Canada, so Manitoba, Saskatchewan, Alberta. And that market, since I'm going to say 2010, has doubled. And it's gone from what was a million ton phosphate market to over 2.3 million tons today. And that's the type of market, that's the type of growth that will get a major's attention. Now, to address your concept of the NPV of a project of this size and my market cap was, we had done a bankable feasibility in a company that I ran, a predecessor company, back in 2008, and we basically did the pre-feasibility, and we're starting the bankable feasibility, and we stopped when the financial crisis hit. And then that company went on to merge with another company and 2016, and this asset became non-core. And that's what was now the formation of Fox River, because that asset was spun out to the Phoscan Chemical Corp shareholders before Phoscan merged with the other company. And it sat dormant, basically waiting for an egg cycle.
Interesting. Yeah, it's like, how much has been spent on the project so far? Like, I'm just looking at the market cap.
My predecessor company, we spent $35 million over a 3-year period, and then in this particular company, we've just spent $2 million doing a really regaining your economics around the project. That was what this was all about. I mean, you had the design, you had a pre-feasibility done. This time we're simply mining out both our inferred and our indicated resources, and that's why it's being done as a PEA. It's the same engineering, it's a larger plant, a higher capex, but that's what these projects generally run. That's not an unusual capex for this size of project.
Yeah, I looked at the numbers and I find them quite interesting because like the pre-tax numbers are fantastic, like 8% NPV, $3.5 billion, 27% IRR. That's not bad for a project of that size. Like, what is the couple capex on a build like that?
Well, I mean, if you look at, I'll give you an example. First of all, I would look at this as an after tax, right? I mean, that's how I would suggest people look at this thing. In an after tax, it was, I think it was a 1.4 billion, and these are all US dollars, by the way. Yeah. And an IRR around north of 17%. That's a very good IRR for a project like this. This is a bulk commodity. You're producing almost 1 million tons of product at the end of the day. I think 942 million or 1,000 tons to be exact.
And Steve, that's your base case. That's not the current market situation. That is base case.
Yes, exactly.
So, and how does the base case sort of differ from the current market price environment? And
well, you have higher prices. I mean, you're 30-40% higher prices. So, and they're still going. I mean, I guess the easiest way to say this is back in 2009, I think the high, we're about $100 off the high, and where prices are today. and and they're going to go a lot higher. There's no question. Now, I did not foresee the Russia. What I foresaw was that we were in an environment where fuel was tugging on the food chain again, and you get these kind of cycles.
Interesting. Like, how did you use how did price discovery sort of work for phosphate? Like, what did you use as a basis? Like in gold, it's always like 2 years back, 2 years forward, and then they just take consensus.
This was basically a 3 scenario base case. So you're taking an average of 3 scenarios. I didn't do this these numbers. A gentleman by the name of Mike Rom, who had done it for a number of years for Cargill's fertilizer division and then Mosaic's fertilizer division. This is what he specialized in, and he derived the numbers and the base case, and obviously you would like the market to know what the project looks like at today's prices. Now, when I say today's prices, those prices are from the middle of April. They're about $100 a ton higher than what my current prices are today. That's what happens. I mean, when you get grain prices at all-time highs, your fertilizer prices are going to follow suit.
No, that makes sense. Let's look at this. Like, so you spent $2 million on the PEA. What are the next steps now? Like for a company of your size?
The next step for us is we are not the builder of this project. I mean, we will never have a $1.8 billion balance sheet. So from reality, we are a de-risker of this asset. We're the developer of the asset to a certain stage, and then we will be a seller of either to a major fertilizer company, private equity. There are guys that are in the private equity business that run big funds that look at these assets and can sit on them for 10 years. But from our perspective, my job is to eliminate the risks and create the value for my shareholders, and the glide path for a major to come in and build this. And this is why when people say to me, it's $1.8 billion, wow. Well, I'll tell you, thank God I'm not a $500 million project, because I can tell you there isn't a major in the world that's going to have any interest in building a $500 million project, because this is a well-consolidated business. There's only 14, global players. And their issue becomes they can't consolidate anymore, and a $2 billion project kind of barely meets the needle. So you have to look at it from their perspective.
Yeah, it's interesting because we often talk to gold exploration companies and juniors. It's like, we don't want to get to over $100 million capex or so. It's just a completely different world. Like if you talk 250, you're already on the higher end of a construction cost, right? So it's just a different world.
It's totally different.
Absolutely. But you said to de-risk it, to get it to that takeout, like to that exit scenario. What does that include? Like, do you really need to do a feasibility study? Is PEA enough because you did based on it?
No. Look, in all, and to be frank, you're $50 million away from making a production decision, and we would not behave any different than a major. This PEA was done to be able to do what's at the end of the day, what's necessary is to hand this off to a major. I didn't really do the PEA for the market. I did the PEA for having numbers that will hold up at this kind of scrutiny in the due diligence course that a major fertilizer company would do. And that's what these numbers represent, right? And so for the level we are now, the next step from us is twofold. It needs, you're going to put another 150 drill holes into that deposit before you're ever going to make a production decision. And so from my perspective, that's the next step. There are other things that are important to us that we will do. We'll get better density, because I can't really tell you whether my resources have got the right density yet, and that's important, right? We've been quite conservative, and if I'm off 10%, and I got 10% higher density, I'm selling my shareholders 10% short. So there are things that need to be done. And you want to eliminate the risks for the major. You're creating a guide path for a major to come in and develop this thing. Right? And that's everything from, First Nation agreements to any kind of engineering or anything that you need to do to do that.
Yeah. Looking at cap structure, you had $1.2 million in the bank, I think, at the end of January, if I'm not mistaken. I briefly looked at the PowerPoint. How far does that take you? Do you like, now that the PEA is out, are you open for financing ideas, joint ventures?
We're open to, we're going to raise some capital. The question is how much, and that will be determined on the stock price. I don't have no interest in raising capital here. But I will rather, I will get the appetite of the institutions. That's my job to do that. And we will do that. But at the same time, if I don't see the right structure, why would I dilute myself when I'm a seller at the end of the day? I'm diluting myself to add value. If I can't add value, then why am I doing that, right?
No, Steve, that makes perfect sense, right? And I warned you I'll ask that question, but you're a CSE listed company, so I'm breaking a bit of my own personal taboo speaking and interviewing a CSE company. But you come highly recommended. One of my friends is the CFO of your company. I was like, I had to check this out. And but is that hindersome to be on the CSE? Because I see it in the gold space that some of the funds use it as an excuse not to invest into a company because they say, well, our let's say bylaws don't allow us, right?
So I've never had that experience. I have found, that when an institution wants to invest in you because you're in a sector that they want to invest in, they don't care where you're listed. And that's been my experience. I mean, I've been in all three exchanges or in the last two companies I've run. So, I'm less fussed than most people are about that. I think if an institution's telling you that you're on the wrong stock exchange, he most likely is just giving you an excuse of why he's not wanting to invest. Because, I would take the marijuana experience that happened up here as a classic example. There wasn't an institution that ever turned down one of those marijuana companies because they were on the CSE. And that's the only exchange they were allowed to be on all through that. So.
Interesting. Okay. I saw Dave Lotan, and Lotan Holdings are a 10% shareholder as well. How active is he in the company?
Well, Dave's not active, but Dave and I have known each other quite a long time. I have an immense respect for him. He runs his own company and he's a busy guy. But we talk, we communicate, and he's a great shareholder. You couldn't ask for a better shareholder. He's there for you, right? If you ask, if you need him for something, he's there. He's the kind of shareholder you want to have. And quite frankly, I like to choose my shareholders because, there's an old adage in this business. I can sell a stock once or a share once, or I'm going to have to sell it over and over and over again. And this is the same whether you're a retail, or institutional. Pick your shareholders wisely.
Yeah, right. No, that makes sense. Perfect. You sort of put a bow around it. It was super informational, but let's put a bow around next catalysts. What do you expect to come out? I think we're due for a technical report, obviously, within the next 45 days.
Yes.
But what else can we look forward to in terms of news flow?
Well, I think that, we've got to do some investigation on some things like niobium and the rare earths that are in there. And we've done some work on it. Some of it's been encouraging. Some of it we still haven't unlocked. That's a huge if we can, in our situation, it's metallurgical, right? So if we can unlock that, then that's all bets are off on that. And then the other thing that I think that from our perspective, we'll make a decision as to what the next steps are corporately, and then we'll start executing those.
Fantastic. Stephen, thank you so much for joining us. Thanks for shedding some light on the PEA. It was super insightful. I learned a lot, especially about the phosphate market and what the drivers and demand keys are. Super interesting because you're the only phosphate project I've come across recently that's in Canada as well.
Well, just for your audience, there are three, right? One is an operating asset, and the other is a igneous phosphate deposit, and that's very important because if you're igneous, you can, like, if you look at the phosphate fertilizer regulations in Europe, cadmium restrictions are in place, and that's something that's coming here eventually. Is cadmium follows the food chain and it's a carcinogenic, and they have implemented that, and that goes in July 2022. And if you're a sedimentary deposit, you're eventually going to have to spend capital and have a higher operating cost. And by the way, 85% of the global phosphate production is from sedimentary deposits, and all the North American phosphate production is. And if you ever get the US or Canada to restrict cadmium restrictions, if you're igneous, you already can pass the most stringent European conditions. And that's a big thing that people should understand and before they invest in any kind of phosphate play.
Yeah. It's interesting. It sounds as multifaceted as sort of rare earth investing or even graphite investing, because it's also about the process in behind. Because I saw you're supposed to spend $250 million on a sulfuric acid plant.
Yes. Yeah,
right.
That's part of the cogen. So it's, when you create sulfuric acid, it's from molten sulfur. You're creating an exothermic reaction, and you get steam, which you're using for your evaporation process, but you also get your power. And we have carbon rules up and carbon taxes in Canada already. We're not like the Americans that haven't implemented it yet, and so you have to drive towards those things. And that generation of electricity allows us to feed our beneficiation plant up at mine site, all the fertilizer complex, and you're basically making 31 megawatts of power.
That's fantastic. You're ESG compliant. You can probably sell it to the market, eh?
We could, but we're using it all. Right. So it lowers your production costs, right, quite a bit.
Gotcha.
You're not buying power.
Interesting. Oh, another interesting aspect. Steve, we need to do a follow-up on this and dive a little deeper into the matter. I didn't want to get too technical because I had like a zillion follow-up questions on the PA. Why this? Why that? But let's not get too technical. Just congrats on the PA. I think it looks really enticing. And I'm going to follow the company a little closer in the coming months. So thanks so much for joining us, Steve.
Thank you.
Fantastic. And everybody else, thank you so much for joining us. This was SF Live episode 253. We were joined by Stephen Case. Well, I wanted to say Coates because I just spoke with Stephen Coates. So I apologize for that, Steve. But it was super insightful. I learned quite a bit about Phosphate. The company just put out a PEA this morning as well. So take a look at it. I link to the website in the description below. And to give us a like, give us a follow, subscribe to the channel. It is much appreciated. And we'll be back with more live content and more updates very, very soon. Thank you so much.